David, great to have you back on the show. What's holding gold back from the test of that 1362.40, the 2017 highs?
Well, I think we're going to move higher in our numbers of gold because we're in a bull market that started about a year and a half ago when it hit its bottom of $1,050. And when you look at the mining costs of gold, according to the World Gold Council, 1,050 is the low and 1,425 is the high. So we're right in that range, and I think we're going to see higher prices in gold this year as a result of higher interest rates, the Fed, a few wild cards out there, but I think we're in a bull market still this year, and next year is going to be the biggest bull market we're going to see in quite some time.
We talk a lot here on this show and on our Swim Lessons broadcast about the dollar relationship with gold. We talk about a macroeconomic effect of the dollar. Is this going to turn into a micro trade with gold and kind of defy wherever the dollar goes?
Well, I think last year we saw 5 cycles in the gold market, the lasting from 28 days up to 60 days. And during that cycle, the smallest movement, Kevin, was 6.4%, and the larger movement was 11.3%. So there's a direct correlation that we can make some money as a short-term trader in gold. And I think we're going to see that type of volatility again. Silver had 4 trends upward, but gold, the leader of the trends last year. I think we're going to see some higher prices in gold because we have unseenable debt. So we have some debt increases happening. We have a tax plan that is adding $1.5 trillion to deficit spending in the next 10 years, $6 trillion at a current government spending rate, another trillion if they pass the infrastructure bill, and $0.5 trillion of miscellaneous spending plus higher interest rates on that debt. I think we're going to see a higher debt for our country, around $9 trillion. And then when you look at historically, higher debt causes higher gold prices. So that's another driving force behind gold this year.
All right. Hey, David, how about copper? That seems to have lost some of the follow-through that we were seeing as well recently, again, running it up there, but seems to have lost some of the enthusiasm to the upside recently.
Well, copper's been used quite a bit in the housing, even though medium housing went up 6% in the United States. And certainly China has backed away from their housing projects. That has resulted in lower prices of copper. And I don't see a major movement up this year in copper like we saw last year. I think that trade is well overrun, and I wouldn't be operating in that mechanism.
David, last time on the show, you mentioned the bid that we're seeing in palladium. Looks like the last push up has palladium above 1,100. What's behind the new highs, and should we expect more to come, frankly?
Palladium has had a few cycles in it, although it went up 55%. That's the biggest of the 4 metals, gold, silver, platinum, and palladium movements that we saw. And I think we're going to continue to see higher. I think we might even reach the $1,200 level. I know that sounds pretty rich, but the automobile industry is the hugest user of palladium. And China is doubling their buying of automobiles, is what the Consumer Reports out of China has said. So we could see definitely higher prices than palladium. I think, though, gold is the thing to be looking at for the cycles of trading in the 5 cycles we saw last year. I think we're going to see some repetitiveness of that.
David, does the dollar play into this palladium trade at all, or is this primarily driven by the auto industry?
No, this is an industrial trade. Central banks are the ones that are concerned about what's going on with the debt and the dollar. And so that's the biggest buyers of gold in the marketplace. So that's what's really driving the gold market. Palladium is not bought by central banks, to my knowledge. It's more of an industrial aspect play.
All right. Being a grains guy, I look for cyclical patterns, right? Are there any cyclical patterns we should watch for in the gold trade?
Well, the gold trade usually moves up in the fall when China is buying jewelry, and so is India. So we didn't see a big movement as a result of that. And the cycles that we normally see in gold, it becomes dormant somewhat in the summertime, and it does have a small rise from January to April. But last year, all the mechanisms of our normal trades in golds were thrown out the window. And I think a lot of that has to do with a new president. I think some of it has to do with the Fed now raising rates. And they want to unwind the balance sheet. They got 5 $4.5 trillion on their balance sheet. 2.3 trillion of that is in treasuries, and that's the number one thing that they want to unwind. So when they start unwinding that, I think we're going to see some wild cards in the gold market, because we don't know how this will affect. Historically, 5 out of the 6 times the Fed has unwound the balance sheet, we've had recessionary environments. But I think this time we're going to move towards inflationary environments.
All right, David, good, great information there. Once again, a pleasure to have you on the show, and we look forward to having you back.